Hey everyone, welcome back to Corporate Decoder, and today we're diving into a filing that's all about carefully planned growth, like a financial mastermind orchestrating a symphony of investments. But let's see if that symphony is hitting all the right notes or if there are some dissonant chords in there. We're talking about the Ironwood Institutional Multi-Strategy Fund LLC, and this document lays out their strategy for raising a big chunk of cash, over $1 billion actually, to invest in a bunch of other investment funds. Now, usually I love digging into those juicy financial tables, and we'll get there, but first, what's the big picture here? Ironwood is basically playing a game of financial chess, investing in other funds that themselves invest in all sorts of stuff, from relative value strategies to event-driven opportunities. It's like a fund of funds, if you will, aiming for capital appreciation while trying to keep things from getting too wild and unpredictable. They're a closed-end company, which means shares aren't easily bought and sold like in a regular mutual fund, and importantly, they're not listed on any stock exchange. This lack of easy trading means investors need to be prepared for their money to be tied up for a while. They also invest in these underlying funds, over which Ironwood has no direct control. Now, let's talk risks, because there are quite a few. They explicitly state that these investments are speculative and carry substantial risks, including losing all your money, which is always a good start in a risk disclosure. A major theme is illiquidity. The underlying funds themselves have restrictions on withdrawing money, and this can directly impact Ironwood's ability to meet requests from its own investors. They can't just sell something to raise cash if the underlying funds make it difficult to pull money out. We also see a table here outlining the board of directors. You've got some independent directors and then Jonathan Gans, who is also the CEO and president of Ironwood, acting as an interested director. It's pretty standard for these structures, but something to note. Now let's get to the numbers, because this is where things can get really interesting, especially with a fund of funds structure. This is the summary of expenses, and wow, that acquired fund fees and expenses line is massive. It's sitting at 25,466%. This is essentially the cost of investing in all those other underlying funds, including their management and performance fees. Looking closer at that breakdown, underlying fund management fees are 1.39% and underlying fund performance-based fees are 2.67%. Then you have underlying fund operating expenses at 3.91% and a huge 17.49% for underlying fund trading expenses. It all adds up to a staggering 26.85% in gross annual expenses. After a fee waiver, it still comes to a net 26.85% in gross annual expenses. After a fee waiver, it still comes to a net 26.85% in gross annual expenses. After a fee waiver, it still comes to a net 26.85% in gross annual expenses. After a fee waiver, it still comes to a net 26.85% in gross annual expenses. After a fee waiver, it still comes to a net 26.85% in gross annual expenses. A 26.85% expense ratio, that's extremely high, even for the world of hedge funds and funds of hedge funds. For context, a typical mutual fund might have an expense ratio of less than 1%, and even many actively managed ETFs are well under 1%. This means that for every dollar the fund makes, nearly 27 cents is going just to cover the cost spread across the entire investment chain. That's a massive drag on potential returns. This example table illustrates the cost of investing. On a $1,000 investment, they estimate you'd pay $243 in net annual expenses for just 1 year. If you assume a 5% annual return, that's nearly a quarter of your profits gone on fees in a single year. Over 10 years, that hypothetical $1,000 investment would cost you over $1,000 in fees alone. This really highlights how critical expense ratios are, especially when they're this high. Looking at the total returns for previous years, they show a range of performance. For example, in the year ended April 30, 2025, the total return was 9.17%, but that's before considering any of these mega fees. The ratio of total expenses to average net assets before waivers is 1.39%, which seems much lower than the 26.85% detailed in the summary of expenses. This discrepancy is likely because the 26.85% detailed in the summary of expenses, this discrepancy is likely because the 26.85% detailed in the summary of expenses, this discrepancy is likely because the 26.85% figure includes the acquired fund fees and expenses which are passed through from the underlying funds, whereas the 1.39% relates to the direct expenses of the Ironwood fund itself. Even the direct expenses are substantial. This section presents performance data for all discretionary accounts managed by Ironwood, not just this specific fund. It's meant to give a broader picture. We see total firm assets growing over the years, but the performance figures are what capture my attention. The annual net performance highest fee, the base for 2024 was 9.99%. For 2023, it was 6.21%. While these numbers might seem okay on the surface, remember that this is before the substantial acquired fund fees we saw earlier. The overall net performance after all layers of fees in their own filings, like in the summary of expenses, would be significantly lower. They do include the crucial disclaimer that past performance is not indicative of future results. So what's my take? Ironwood is clearly aiming for a sophisticated investor base with this multi-strategy fund of funds approach. The goal of capital appreciation with limited variability is appealing, especially in volatile markets. However, that sky-high expense ratio is a massive red flag. It means the underlying investments need to perform exceptionally well just to break even after fees, let alone generate significant returns for investors. The illiquidity aspect also means investors need a very long-term outlook and shouldn't need access to their capital on short notice. The company's strategy relies heavily on Ironwood's ability to select top-performing underlying managers, and the sheer scale of the acquired fund fees suggests that even good underlying performance can be significantly eroded before it reaches the investor. It's a high-risk, high-cost structure that needs truly outstanding results to justify. On short notice, the company's strategy relies heavily on Ironwood's ability to select top-performing underlying managers and the sheer scale. Alright, that's our breakdown Ironwood's filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.